Every investor managing money today was born after 1960, which means not one of them remembers what a true depression looks like. The last generation who survived October 1929 has vanished from Wall Street trading floors, and they tried to pass down a warning manual before they disappeared. Nobody listened. After the 2008 recovery, business schools threw out the old playbook and stopped teaching the Depression-era case studies in any meaningful depth. The Federal Reserve minutes from 1927 through 1930 now gather dust in archives, and modern traders have never bothered to read them. If they did, they'd recognize the exact same language appearing in policy statements from 2023 through 2025. Wall Street veterans with 20 years of experience think they've seen everything, but they haven't seen anything. Their entire careers occurred during the longest bull market in history, interrupted only by brief corrections that recovered within months. They never witnessed a real bear market where wealth vanishes permanently. They never saw the three-phase collapse that preceded October 1929, the denial phase, the volatility phase, and the capitulation phase. Right now, markets are deep into phase 2. The pattern exists and has been documented for 95 years. Financial historians mapped every step of the 1929 sequence in meticulous detail, creating a blueprint that shows exactly how prosperous economies transform into depressions. Modern investors ignore it because it contradicts everything they learned during the permanent bull market era. Markets are leaving clues everywhere, but algorithms can't read them, and neither can traders trained to believe central banks eliminated crashes. Institutional memory has evaporated completely. The boardrooms where depression survivors once sat are now occupied by analysts who've never experienced sustained decline. And those survivors understood something fundamental that current generations have forgotten. They recognized warning signs before catastrophe arrived and knew exactly what unsustainable prosperity looked like. They watched investment vehicles inflate beyond any rational valuation, while professional classes convinced themselves that the business cycle had been conquered. They saw colleagues dismiss obvious dangers as old-fashioned thinking. The Federal Reserve meeting rooms looked the same across decades. Conference tables, economic charts, policy statements prepared for public release. But the people occupying those chairs in 2025 lack crucial context. When Fed officials wrote in 1928 that the economy showed strong fundamentals and contained inflation risks, they genuinely believed monetary policy had reached scientific perfection. When officials write the same phrases today, they believe the same thing. And history has already recorded what happened next. The survivors tried to teach us about prosperity so convincing that skepticism became a career liability. They described investment trusts growing 700% in 3 years, and utility companies building pyramid structures that controlled billions through leverage. They explained how margin requirements dropped to 10%, letting speculators control 10 times their actual capital. Every warning sign was visible in 1928, and every metric showed unsustainable expansion. Yet bankers, economists, and government officials convinced themselves they had engineered a permanent prosperity machine. The blueprint documented exactly how professional classes rationalize obvious danger, and showed how institutional incentives prevent recognition until collapse becomes inevitable. That same pattern is unfolding now, step by step, page by page. The survivors knew what came next and tried to warn us before disappearing forever. The survivors who tried to warn us described something modern investors can't fathom: prosperity so convincing that skepticism became a career liability. In 1928, questioning the market's trajectory meant questioning progress itself, and the financial infrastructure had become a machine designed to eliminate doubt while amplifying delusion. Investment trusts became the phenomenon that captured the era's imagination and greed. These vehicles, the precursors to modern mutual funds, grew from $1 billion in 1926 to $8 billion by 1929, a 700% expansion in just 3 years. But these weren't simple investment pools. They were leverage machines, wrapped in the promise of professional management. And investors poured money into them without understanding the pyramid structures hidden beneath. Utility holding companies became the, quote, tech stocks of the 1920s. And Samuel Insull built an empire that demonstrated exactly how far financial engineering could stretch before snapping. His utility pyramid controlled $2.5 billion in assets through a mere $500 million in holding companies. 5-to-1 leverage stacked in layers that let small amounts of equity command vast infrastructure. Investors believed electricity would eliminate business cycles entirely, that demand for power represented perpetual growth immune to economic downturns. The reasoning seemed sound because everyone could see the utility towers being constructed across the American landscape. Physical proof that the investment thesis was real. RCA stock embodied the era's speculative fever in a single ticker symbol. Shares climbed from $85 to $505 during 1928 alone, and the company paid zero dividends throughout this meteoric rise. Pure speculation on radio's future drove the price, with investors buying not on cash flows, but on stories about how radio would transform civilization. The company's fundamentals became irrelevant because the narrative felt more real than the balance sheet. Goldman Sachs launched its trading corporation in December 1928 and raised $100 million in hours, demonstrating how thoroughly the investment trust mania had captured public imagination. The Shenandoah Corporation, another investment trust, sold shares at $17.80 when underlying assets were worth just $15.87. Investors didn't care about the immediate losses baked into the structure because they believed the trust managers possessed special abilities to generate returns. The consumer economy was being revolutionized through installment buying, which reached 60% of all automobile and furniture purchases by 1929. This represented a fundamental shift in American financial behavior, where debt transformed from something shameful into a tool for accessing prosperity immediately, rather than waiting to save. Luxury automobiles rolled off assembly lines, destined for buyers who had put down only a fraction of the purchase price, betting their future incomes would cover the payments. Charles Mitchell's National City Bank made loans specifically designed for stock speculation, creating a direct pipeline between banking deposits and equity markets. Meanwhile, bankers' pools manipulated individual stocks by coordinating purchases to create false volume that retail investors interpreted as genuine demand. The infrastructure of delusion operated openly because regulators saw rising markets as evidence of economic health, rather than warning signs of excess. Margin requirements had dropped to 10%, meaning $1,000 could control $10,000 in stocks. This wasn't viewed as dangerous leverage, but as financial democratization, giving ordinary Americans access to wealth-building opportunities previously reserved for the rich. Borrowed money poured into equity markets as brokerage houses, investment trusts, and margin accounts enabled purchases with minimal capital down. Over $8.5 billion was out on loan by August 1929, more than the entire amount of currency circulating in the United States at the time. The Florida land bubble of 1925 and 1926 had collapsed spectacularly, leaving swampland marked with sold signs and buyers holding worthless deeds. But investors treated this as an isolated event, a regional mania disconnected from the sophisticated financial markets of New York. The warning went unheeded because it didn't fit the narrative of permanent prosperity that professionals had constructed. Every warning sign was visible, and every metric showed unsustainable expansion. Yet the professional class, bankers, economists, government officials, had convinced themselves they'd engineered a permanent prosperity machine that had transcended old limitations. We're navigating by instruments that were deliberately recalibrated to show green lights, and the actual gauges measuring stress in the system aren't even on the dashboard anymore. This represents something more insidious than simple oversight. It's systematic mismeasurement, designed to obscure instability until the moment it becomes irreversible. Official unemployment sits at 3.8%, a figure that suggests near-perfect labor market conditions. But this metric excludes 7.2 million people who stopped looking for work entirely. And when those discouraged workers get added back into the calculation, the real jobless rate climbs closer to 7.1%. The measurement system was redesigned to make the problem invisible, rather than solving the underlying weakness in employment. GDP growth appears healthy on the surface, but the composition reveals a troubling dependency. Government deficit spending reached $1.8 trillion in 2024, And if that federal borrowing gets removed from the calculation, growth turns negative. The economy isn't expanding through productive activity. It's being propped up through debt accumulation that eventually requires repayment or default. Corporate profit margins reached 12.8% versus the historical average of 8.2%, representing an unsustainable elevation achieved through wage suppression rather than genuine productivity gains. Companies are extracting more from existing operations while investing less in future capacity. And these margins compress violently during economic downturns as fixed costs overwhelm shrinking revenues. Stock buybacks hit $923 billion in 2024, revealing how companies borrow money to inflate share prices rather than invest in operations or research. This financial engineering creates the appearance of per-share earnings growth without actual business expansion. And the debt used to fund these buybacks becomes an anchor when credit conditions tighten. The Buffett indicator, which measures total market capitalization relative to GDP, stands at 195%, compared to 135% at the 1929 peak. This suggests current valuations exceed even the most speculative period in American financial history. Yet analysts treat this as normal because valuations have remained elevated for years. The measurement problem extends beyond individual metrics to the fundamental approach. In 1929, investors used price-to-earnings ratios religiously, but that metric couldn't capture the leverage hidden inside investment trusts. The debt stacked beneath the equity made PE ratios meaningless. Today's investors worship EBITDA and adjusted earnings, both of which exclude actual cash expenses that companies must eventually pay. WeWork's 2019 valuation of $47 billion relied on community-adjusted EBITDA, a metric the company invented specifically to make losses appear as profits. This parallels exactly how investment trusts in 1928 reported net asset value while excluding their own debt from the calculation. The pattern repeats because the incentive to deceive remains constant. Companies need funding, and inflated metrics attract capital from investors who don't scrutinize the definitions. The Federal Reserve watches core inflation, which strips out food and energy, exactly what consumers actually buy, making the measurement useless for understanding household financial stress. No major index tracks corporate debt levels relative to revenue, so the leverage accumulation happens outside the view of the metrics that investors monitor daily. Treasury markets show $24 trillion in outstanding debt, experiencing liquidity cracks similar to the UK gilt crisis of 2024. But these stresses don't appear on any mainstream dashboard. Commercial real estate values dropped 35%, but aren't reflected in bank balance sheets due to extend and pretend loan accounting that delays recognizing losses until the positions become completely worthless. The instruments weren't broken. They were recalibrated, deliberately. And when markets finally adjust to reality rather than massaged metrics, the entire navigation system that guided investors into danger won't be able to guide them back out. The leverage isn't the problem. It's the leverage on top of leverage on top of leverage, connected by derivatives that nobody fully mapped. When one link breaks, the entire chain doesn't just fall, it vaporizes. Private equity firms control $5.8 trillion using $3.2 trillion of borrowed money, representing a 55% leverage ratio that amplifies both gains and losses across the entire alternative investment sector. These aren't simple loans that can be repaid gradually. They're structured with covenants and triggers that force liquidation when values decline beyond specific thresholds. Collateralized loan obligations package risky corporate loans into tranches that get sold to pension funds and insurance companies, mirroring the exact CDO structure that detonated in 2008. The CLO market reached $1.4 trillion by 2024, and these instruments hold loans to companies already carrying dangerous debt levels. When the underlying companies struggle to service their borrowings, the CLO values drop simultaneously across thousands of portfolios. Hedge fund leverage averages 4-to-1, but volatility targeting strategies can spike to 10-to-1 during calm periods when algorithms determine that low volatility justifies higher risk-taking. This creates a perverse dynamic where leverage peaks exactly when markets appear safest, positioning maximum exposure right before conditions deteriorate. Even sovereign wealth funds borrowed $420 billion in 2024 to maintain spending levels, meaning oil-producing nations that should represent financial stability are themselves leveraged. Japanese pension funds hold $380 billion in foreign bonds, using currency hedges that break during volatility spikes, forcing liquidation of the underlying positions at exactly the wrong moment. The cascade mechanism follows a predictable sequence that accelerates with each step. A volatility spike triggers algorithm deleveraging as trading systems automatically reduce risk exposure. This forced selling hits corporate bond markets first, because they have lower liquidity than equities, and prices gap down sharply. Falling CLO values trigger margin calls on institutional holders, who must post additional collateral or sell positions. Private equity funds discover they can't exit their holdings because buyers have disappeared, forcing redemption freezes that trap investor capital. Pension funds begin selling whatever remains liquid, creating sovereign debt stress as government bonds face unexpected supply pressure. The 1929 cascade started with margin calls on individual investors and took 3 days to spread system-wide. Today's cascade starts with institutional leverage that's 1,000 times larger in scale, and algorithmic trading could complete the entire sequence in 3 hours rather than 3 days. The critical difference lies in transparency. 1929 leverage was visible in margin account statements that regulators and investors could monitor. But today's leverage hides inside derivatives and swap agreements that don't appear on balance sheets. Archegos Capital's collapse in March 2021 demonstrated how hidden leverage creates catastrophic surprises. This $20 billion fund used total return swaps to control $160 billion in positions, 8-to-1 hidden leverage that banks didn't realize had concentrated identical exposures across their trading desks. When positions moved against Archegos, multiple banks simultaneously liquidated $10 billion in holdings, vaporizing value instantly. The UK pension crisis of September 2022 showed how liability-driven investments create cascade vulnerability. $1.5 trillion in pension assets nearly collapsed within 72 hours when gilt yields moved faster than hedging strategies could respond. Only emergency Bank of England intervention prevented complete system failure, and that rescue required unlimited buying commitments that wouldn't be credible if deployed again soon. Silicon Valley Bank's collapse revealed duration mismatch at scale. Long-dated bonds, funded by short-term deposits, created a gap that remained invisible until depositors wanted their money back. The contagion spread to 3 more regional banks within 10 days, demonstrating how quickly confidence evaporates once the cascade begins. The leverage wasn't hidden in complex derivatives, but in the fundamental structure of maturity transformation that every bank performs daily. It's not that they don't see the warning signs, it's that their entire professional existence depends on not seeing them. The denial isn't ignorance, but institutional self-preservation, built into career structures and incentive systems that make recognition financially suicidal. Career risk asymmetry creates a perverse dynamic where fund managers who go to cash and miss a rally lose clients immediately, but managers who stay invested and lose money alongside everyone else keep their jobs because the losses were unavoidable market conditions. This means the rational career move is maintaining equity exposure regardless of valuation, because individual punishment for caution exceeds collective punishment for disaster. The Great Moderation myth conditioned an entire profession over 40 years of declining volatility to believe that central bank interventions had permanently tamed business cycles. This generational experience became embedded in professional training, where younger analysts learned from managers who learned from predecessors, creating an unbroken chain of confirmation bias stretching back to the early 1980s, when Paul Volcker's inflation fight marked the last genuine crisis that policy didn't immediately reverse. Regulatory capture ensures that the officials supposedly monitoring risk have every incentive to minimize its appearance. SEC enforcement lawyers spend their careers preparing for private sector positions at the firms they currently regulate, and 31 of 48 top enforcement officials joined defense firms between 2014 and 2024. This revolving door guarantees that aggressive enforcement becomes career-limiting, while lenient oversight opens lucrative opportunities. Academic economics departments receive substantial funding from the financial industry, producing research that validates current system structures rather than questioning fundamental stability. Universities teaching efficient market hypothesis and modern portfolio theory create graduates who enter the profession believing that markets cannot be systematically mispriced and that diversification eliminates risk, both assumptions that fail catastrophically during systemic crises. Media organizations depend on active trading for their revenue models, making bearish content a threat to engagement metrics and advertising rates. CNBC, Bloomberg, and the Wall Street Journal profit when markets are active and audiences are engaged, not when investors are sitting in cash waiting for better valuations. This creates editorial pressure toward optimism that operates independently of any conspiracy. The business model itself requires bullish narratives. The 1929 generation remembered the panic of 1907 just 22 years earlier, maintaining institutional memory of how quickly confidence could evaporate. The current generation's worst experience was 2008 through 2009, which ended with a V-shaped recovery that taught the wrong lesson entirely, that crashes represent buying opportunities rather than wealth destruction. Modern portfolio theory and efficient markets hypothesis didn't exist in the 1920s, but today's professionals have theoretical frameworks that mathematically deny crash possibility, turning denial into sophisticated quantitative analysis. JP Morgan's quantitative strategy team assigns just 3% probability to recession in 2026. Not through malice, but through models calibrated on the Great Moderation period, when central banks successfully intervened during every previous stress. The Fed put option that investors rely on kept rising in strike price. 10% market drops triggered intervention in 1998, 20% drops in 2018, but by 2024 it would require 35% declines to activate the same response, because prior interventions depleted available tools. University endowments face regulatory requirements to assume 7.5% annual returns, making cash or bond positions impossible to justify, regardless of market valuations. BlackRock's risk parity strategies mandate specific allocations across asset classes, independent of price, forcing buying when valuations reach extremes. The denial infrastructure isn't a conspiracy, but an emergent property of interconnected incentives that make recognition impossible until collapse makes it unavoidable. The valuations aren't predictions, they're prayers, and the entire market structure now depends on those prayers being answered. Because if reality adjusts prices to fundamentals, the leverage cascade doesn't just start, it's already game over. The Magnificent Seven tech stocks trade at an average of 38 times earnings, compared to the remaining S&P 493 companies at 19 times, creating concentration that mirrors the Nifty 50 phenomenon that preceded previous market corrections. This disparity means market performance depends entirely on continued multiple expansion in a handful of names. And when those multiples contract, index-level diversification provides no protection, because the indices themselves are concentrated bets. NVIDIA's price-to-earnings ratio of 66 assumes AI chip demand grows 40% annually through 2030, a trajectory without precedent in semiconductor history. No chip category has ever sustained that growth rate for a decade, because technological cycles move through adoption, saturation, and commoditization faster than linear projections assume. The valuation prices in perfection, while the industry historically delivers cycles. Private market valuations tell a different story than public market optimism, with 2024 venture funding rounds averaging 28% discounts from 2021 peaks. But companies haven't cut their public valuations to match, creating a gap between what informed insiders will pay and what public market prices suggest. This disconnect reveals that professionals with access to detailed financials are valuing these businesses far below what the narrative-driven public markets accept. Commercial real estate presents an inverted reality, where buildings sell for higher prices despite 40% vacancy increases. The cap rate compression defies the fundamental relationship between occupancy and value, sustained only by extend and pretend loan accounting that delays recognition of losses. Banks holding these loans at inflated values create phantom equity on balance sheets that evaporates the moment honest pricing occurs. The art market reached records, with a Basquiat painting selling for $110 million in 2022, then resold privately in 2024 at an estimated $65 million, a 40% loss that wasn't reported publicly because private sales don't require disclosure. This pattern repeats across luxury assets, where reported transactions create illusions of sustained value, while quiet disposals at deep discounts reveal actual market-clearing prices. New valuation metrics emerged specifically to justify unsustainable prices. Revenue multiples for unprofitable companies became acceptable, letting Tesla achieve 1929-style valuations by ignoring the absence of earnings. Total addressable market projections assume winner-take-all outcomes without considering competition, substitution, or saturation. Platform value metrics assign worth to user bases with no monetization path, treating attention as equivalent to revenue. Peloton reached $50 billion in valuation during 2021, assuming a permanent shift to home fitness, then collapsed to $1.2 billion, a 96% wealth destruction, when the pandemic-driven behavior proved temporary rather than structural. Rivian Automotive was valued higher than Ford at IPO, despite producing just 156 vehicles annually, with investors pricing in total category dominance, without considering manufacturing realities. WeWork's journey from $47 billion valuation in 2019 to bankruptcy in 2023 demonstrated how thoroughly narrative can overwhelm fundamentals. The entire thesis that office space as subscription would command technology-level multiples collapsed, when actual cash flows couldn't support the debt structure built on imaginary valuations. Cryptocurrency market capitalization peaked at $3 trillion in November 2021, and 60% of that value disappeared. But it was treated as real wealth when rising, despite representing purely speculative positioning. Zoom traded at a price-to-earnings ratio of 370 in 2020, with investors assuming pandemic work patterns would persist indefinitely, ignoring the obvious reversion to historical norms once health conditions normalized. The historical parallel to 1929's Radio Corporation is precise. Both traded at 500 times earnings because investors couldn't conceive of limitations to the underlying technology. Today's electric vehicle companies trade at similar multiples, assuming 100% adoption, despite infrastructure constraints that make complete displacement of internal combustion impossible within any reasonable time frame. Both eras extrapolated current trajectories infinitely, without considering saturation, competition, or technological substitution that always emerges when incumbent technologies become expensive or constrained. These aren't theoretical vulnerabilities. They're tested failures from recent years that regulators patched with duct tape and crossed fingers. The system didn't break in 2019 or 2020 only because authorities deployed trillions instantly. But now those tools are already deployed, debts already accumulated, and the next stress test has no safety net. Treasury market liquidity presents the most dangerous hidden vulnerability in the entire financial system. Daily volume averages $640 billion, suggesting deep and resilient markets. But during stress tests in 2024, $50 billion orders moved prices by 0.4%, 8 times more volatile than 2019 conditions. This means the most liquid market in the world loses that liquidity exactly when it's needed most, transforming the safe asset that anchors all other valuations into a source of contagion. Money market fund reforms created exit bottlenecks that trap investors during panic. If redemptions exceed 10% daily, regulatory gates close automatically, preventing withdrawals and forcing capital to remain in funds regardless of risk. This protection mechanism, designed to prevent runs, actually guarantees runs by creating incentives to exit before the 10% threshold triggers, meaning the first hint of trouble causes stampedes rather than orderly liquidation. Exchange-traded fund structures contain a fatal flaw that appears only during market stress. ETFs trade at 20% discounts to their underlying holdings during flash crashes because market makers step away from their screens when volatility exceeds algorithm parameters. Investors discover they can't exit at fair value because the intermediaries providing liquidity have contractual rights to withdraw precisely when their function becomes critical. Swap lines between central banks show mounting stress that goes unreported in financial media. Fed to ECB borrowing increased 380% during the fourth quarter of 2024, revealing that European banks face dollar funding shortages severe enough to require emergency Fed support. These facilities exist for crisis conditions, and their activation during supposedly normal times indicates problems festering beneath calm surface conditions. Cryptocurrency interdependence with traditional finance creates unexpected contagion pathways. Stablecoins backed by commercial paper represent $130 billion in crypto collateral, and if the commercial paper market freezes like it did in March 2020, that entire crypto infrastructure evaporates instantaneously. The supposed separation between digital and traditional finance is an illusion. They're connected through the same funding markets. High-frequency trading algorithms provide 60% of market liquidity, but these systems shut off automatically when volatility exceeds programmed thresholds. Liquidity disappears exactly when needed, transforming orderly markets into air pockets where prices gap violently because there are no bids. The September 2019 repo market seizure demonstrated this dynamic, when overnight rates spiked from 2% to 10%. Because reserves dropped $120 billion below an unknown threshold that triggered algorithm shutdowns. Settlement system stress represents a ticking time bomb that almost detonated in March 2020. The shift to T+1 settlement, implemented in 2024, gives just 24 hours for trades to clear, and during cascade conditions, the system could jam entirely, as counterparties fail to deliver securities or cash. Bank reserve requirements were eliminated in 2020, removing the buffer between deposits and lending that previously prevented systemic freezes. The March 2020 Treasury market crisis required Fed purchases of $1 trillion in 2 weeks to prevent complete system failure. And that intervention occurred with $2.4 trillion in bank reserves, supporting far less total debt than exists today. The May 2010 flash crash showed how a single 4.1 billion E-mini futures sell order triggered a 1,010-point Dow drop in 36 minutes. December 2021 corporate bond ETFs displayed 15% bid-ask spreads during brief Omicron panic, revealing how quickly even investment-grade credit becomes untradeable. These breaking points weren't fixed. They were papered over with emergency interventions that can't be repeated because the interventions themselves created the vulnerabilities threatening the next crisis. The technology that democratized investing will become the prison during collapse. And retail investors don't just lack information, they lack control. Their money is trapped in systems designed to keep it invested, managed by algorithms programmed for markets that no longer exist. 401k participation reaches 89% of eligible workers, meaning entire retirement savings are locked into the system with structural barriers to exit. These aren't discretionary investment accounts that allow instant liquidation. They're employer-sponsored plans with withdrawal restrictions, tax penalties, and processing delays that transform what appears to be liquid wealth into effectively trapped capital during crisis conditions. Target date funds create a perverse incentive structure that makes crashes worse through automatic rebalancing. As portfolios shrink, these funds automatically buy more stocks to maintain target allocations, forcing purchases during decline rather than allowing defensive positioning. This means the very structure designed to protect unsophisticated investors actually programs them to buy high and continue buying as prices fall, averaging into collapsing positions without any ability to override the automation. Retail trading apps engineered for addiction amplify destructive behavior through gamification features like confetti animations on purchases and push notifications during volatility. These platforms profit from trading volume, not investment returns, creating alignment between company revenue and customer overtrading. The psychological architecture treats investing like mobile gaming, encouraging frequent transactions that generate commissions while destroying long-term wealth. Buy the dip psychology has been conditioned by 15 years of successful rebounds, where every decline represented a buying opportunity that recovered within months. This Pavlovian response will be catastrophically wrong during secular shifts, where buying falling prices accelerates losses rather than capturing value. Investors trained to interpret declines as opportunities won't recognize the difference between corrections and collapses until their capital has been depleted. Social proof amplification through Reddit, Twitter, and Discord investing communities creates herding behavior at precisely wrong moments. When thousands of retail investors coordinate buying during crashes, they interpret collective action as validation, rather than recognizing that crowd behavior historically marks capitulation points. The technology enabling coordination actually enables synchronized wealth destruction on unprecedented scale. Prospect theory explains why investors hold losing positions hoping for recovery rather than cutting losses. The pain of realizing a loss exceeds the equivalent pleasure of booking a gain. This asymmetry means retail investors will ride positions to zero while clinging to hope, unable to accept that permanent capital impairment is occurring. The sunk cost fallacy operates at portfolio scale, where investors average down on falling stocks because it's only a loss if you sell, transforms into rationalization for holding worthless positions. Retail investors in 2024 surveys rated their investment skill at 7.3 out of 10, yet 88% underperformed index benchmarks. This overconfidence bias peaks after bull markets, when recent success creates false belief in superior ability, making investors particularly vulnerable when conditions change. Recency bias is strongest after extended bull runs. Investors extrapolate recent success into future expectations, despite changing fundamentals. The 2026 collapse will be psychologically worse than 1929 because of structural differences in access and transparency. In 1929, investors could walk into brokerages, sell positions, and receive cash within 3 days, a relatively straightforward process that provided clarity and control. Today, 401k withdrawals take 7 to 10 business days. Early withdrawal penalties discourage exits, and many positions are held in illiquid funds that suspend redemptions during stress. February 2020 demonstrated this dynamic when retail investors bought $10 billion in stock ETFs during the fastest crash in history, doubling down as prices fell, rather than recognizing the danger. Robinhood restricted GameStop trading in January 2021, revealing that retail investors have no actual rights during crisis. Platforms can unilaterally prevent transactions when their own risk management requires it. Celsius Network froze $8 billion in crypto withdrawals during June 2022, locking customers out permanently and demonstrating how digital platforms transform into traps. The contrast between 1929 and 2026 defines the behavioral trap completely. A 1929 investor could walk out of their broker's office with cash in hand. A 2026 investor stares at a screen displaying redemption suspended, with no ability to access their wealth and no timeline for when access might return. The pattern isn't prediction, it's recognition. And the Great Depression followed a script that historians documented thoroughly. Every page of that script is being performed again, with modern props and digital sets, but the same fundamental structure underneath. Those who read it see the ending coming, while those who refuse will be shocked when it arrives on schedule. Insider selling during the fourth quarter of 2024 reached $16.2 billion, the highest level since records began, with CEOs exiting their own company's stock at 4 times the normal rate. These executives have access to information that retail investors will never see: internal forecasts, customer pipeline data, credit line negotiations with banks. When they sell in coordinated waves, it's not random profit-taking, but systematic exit before conditions deteriorate publicly. Sovereign wealth funds shifted 18% of their allocations from stocks to gold and commodities during 2024, a massive repositioning that went largely unreported in financial media. These institutions manage trillions for entire nations and employ teams of analysts with resources far beyond what individual investors can access. Their quiet movement out of equities reveals what sophisticated analysis concludes when freed from the career pressures that force mutual fund managers to stay invested. The preparation divide separates those who recognize patterns from those who trust institutions, and this gap will determine who preserves wealth through the coming collapse versus who experiences complete capital destruction. Historical precedent from 1928 and 1929 shows insiders sold to retail investors at the peak, then blamed the public for speculation afterward, when the crash they anticipated arrived. The narrative shifted from new era of prosperity to irrational exuberance overnight, but only after professionals had exited. Market tops occur when optimism peaks and skepticism disappears completely, a condition that the CNN Fear and Greed Index measured at 82 out of 100 during late 2024. The inverted yield curve that appeared in July 2022 historically precedes recession by 12 to 18 months, placing the timeline for economic contraction squarely in the first half of 2026. The lag effect means Fed rate hikes from 2023 and 2024 take 18 to 24 months to fully impact the economy. So the tightening that seemed manageable during implementation hits with full force through 2025 and 2026. Corporate earnings are already declining, but remain masked by stock buybacks that inflate per-share metrics without creating actual growth. When credit conditions tighten further, buyback activity collapses because companies can't borrow at reasonable rates, and the earnings mirage evaporates instantly. The choice facing investors is binary and unforgiving. Path 1 involves ignoring the pattern, trusting institutions that have every incentive to keep capital invested, and maintaining allocations that expose portfolios to the full cascade when it triggers. Path 2 requires recognizing the pattern, reducing risk exposure, even if it means accepting opportunity costs during the final melt-up phase, and accepting protection from collapse as more valuable than capturing the last gains before destruction. The actual preparation involves holding liquid assets that don't depend on counterparty performance, owning tangible goods that retain utility regardless of financial system stress, and securing income-producing property that generates cash flow rather than depending on price appreciation. This isn't what the financial industry recommends because the industry profits from assets under management and trading commissions, not from clients sitting safely in cash and physical assets. The last survivors tried to pass down the warning manual before they disappeared from trading floors forever. It wasn't complex theory or sophisticated models, just simple pattern recognition that saved their fortunes while neighbors lost everything. That manual exists, gathering dust for 95 years while new generations convinced themselves that modern financial engineering had transcended old limitations. The blueprint reveals the preparation for those who are willing to study it, but the window for action closes as each phase of the pattern progresses toward its documented conclusion.